Good morning, everybody. You are watching a live daily market outlook for Thursday, 14th of February 2013, prepared by Windsor Brokers. A strong risk-off mode is seen at the beginning of today's European session, and of course during the overnight session, but more pressure seen on the single currency at the beginning of European trading hours, as the single currency slid below 134.00 psychological support, with the G20 meeting being in the near-term focus. That the meeting starts today, the meeting of G20 finance ministers and central bank officials that will view the global growth and the differences over currencies that are on agenda of the meeting. And basically this is the hot topic for the coming 2 days, today and tomorrow, and of course they will extend during the weekend. From the other side, quite disappointing data released today, showing that European economy is seen dropping deeper into recession. First of all, there was a release of French and German GDP earlier today, that showed a deep further contraction in the economies, with the European GDP due to be released later on, again expected in the negative figures, and this is signaling that the Eurozone is probably slipping further into the recession in the final quarter of last year, as also Chinese slowdown led even the robust German economy to contract, but modest pickup might be expected in the near term. The bloc's output expected, according to expectations, is to shrink by approximately 0.4% in the fourth quarter, after contracting 0.1% in the third quarter and 0.2% in the second quarter. Given that the Eurozone economy stagnated in January to March period, the fourth quarter figures confirm the bloc recorded its first calendar year with no growth at all. This is of course one of the highlights for today. We are going to take a look on this in the on the calendar. Just to mention that yesterday's U.S. retail sales release shows the growth slows and as higher taxes kick in. This was, we mentioned yesterday, one of the highlights to be watched, and basically yesterday's release showed the slowdown in the U.S. retail sales. Other thing is also important to mention that U.S. stocks are close. Yesterday's trading action was slightly consolidating recent strong gains, with S&P and the Dow Jones hitting their highest levels since 2007. Dow Jones is peaked above 14,000. While S&P hit levels close to the highs of 2007. From today's calendar, not to make it long now before we move to the technicals, what we mentioned already a few things. As we said, the important, I apologize, missed to mention that Bank of Japan released its overnight rate decision, keeping the overnight rates at 0 to 0.10% as expected, with the focus now on the GDPs. French one came showing further contraction, -0.3 is the release compared to -0.2, and the growth seen in the third quarter by 0.2%, while more significant was contraction of the German economy in the fourth quarter from third quarter, 0.2% growth, and the contraction of 0.5% release. Forecasted release was 0.6%. As we said, still to come is Italian and the Eurozone. Italian is also expected to show further contraction with -0.5% forecasted for today, while Eurozone, this is at 9 o'clock, 10 o'clock GMT is the Eurozone GDP release for the fourth quarter. contraction of by 0.4% as seen on today's forecast. I do apologize, we have again a problem. I think for all the, we have technical problem with one of our viewers. For all the settings you have the, at the start page you have all the instructions. I'm not quite sure, I'll have to let one of my colleagues who is in charge for the technical stuff, they will contact you after the session and solve your problem. I'm really not into these things, but we'll continue now the session. In case you have any audio or video problems, until we solve the problem, you can view the recorded version of this session in the YouTube. That will be shortly after the end. It will be loaded in the YouTube on our page called the Windsor Brokers Forex. Now go back to the calendar. I said GDP from Eurozone is expected to show further contraction, and the top release from United States is weekly jobless claims due at 13:30 GMT, 361,000 new claims seen, slightly below previous week's 366, showing that job market is still under pressure and still needs a lot of improvements for overall better picture. G20 meeting, as we said, starts today, and we have a couple of speakers from FOMC, Tarullo and Ballard at 15:30 and 17:50 GMT respectively, and the 30-year bond auction from United States at 8:18 GMT. And at the end of the day, New Zealand retail sales for the fourth quarter, according to a forecast improvement build of 1.1% from 0.4% in the third quarter. And that's all from today's calendar. Economic indicators, the focus is on the GDPs with initial negative tone being given from France and Germany, and likely expected to be followed up by Italy and more important Eurozone's GDP. This was signaled already as single currencies being pressured at the beginning of European session by release of these two French and German GDP data, with more cold water to be poured on the single currency in case of negative, according to expectation, release for the Italy and the more important Eurozone that is due at 10 o'clock GMT. Now we're going to take a look at the technicals and see what we can expect in the coming hours. Quite a negative tone seen on the single currency. I think you see the charts already, or not yet? Do we have any problem here? For some reason I see that you don't see the charts. Can someone confirm? Do you see the chart, or you still see the calendar? And do I have problem here, or just quick message? Do you see the chart or the calendar? See chart. Okay, so it means that the problem is with me, so we can continue. Just a brief look at Euros ADX chart. Hourlies bears firmly in play. Similar is with the 4-hour chart, where the bears are building up following a recent pullback from 135.18. Now to our standard settings. Yesterday's rejection at 135.18. This was required break above 135.00 required to improve the near-term structure on the recovery attempt from 133.52. Basically, the pair rallied to 135.18 near 135.23. That is 76.4% retracement, but failed to hold gains. I mentioned initially that what was required, the break above 134.65. That was yesterday's highs and the intraday highs, and the channel resistance, main bear trend line of 137.10. We cleared this. We cleared the 135.00, and basically the failure to sustain gains triggered this sharp reversal. That on the other reversed Fibonacci picture shows that the pair dipped lower than 76.4% on a slide down to 133.80 seen so far. This is the session's low, with the negative tone now dominating firmly dominating on the lower time frame outlook and keeping the downside pressured as we lost pardon 134.28. These are the previous tops and the consolidation range ceiling, as well as psychological 134.00. Now more focus seen down towards minor supports 133.63 and the key one at 133.52. We can see it better on the 4-hour chart. This is also 50% Fibonacci retracement of the larger 129.96 to 137.10 ascend, and seen as a break point at this moment. If we lose 133.52, we'll be looking for a fresh extension of the down move from 137.10 towards 133.00 psychological support. Sorry, I think there was a small problem with the audio. 133 psychological support, and another significant level is 132.65. This is mid-January's consolidation range floor, as well as 61.8% Fibonacci retracement, and this is also reinforced by ascending 4-hour 55 days exponential moving average, and break here is to confirm the top at 137.10 and allow for some stronger corrective action. As said, a negative tone still dominating on the lower time frames, with the descending indicators on the daily chart and building up bearish momentum. Now seeing a risk of extension down below 133.52 and the 133.00 that would open, we set to 132.65 previous range floor, as well as bull trend line drawn of 126.60 low. Conversely, any bounce higher as hourlies are now oversold, faces 134 as initial barrier, and then we have previous supports seen as a near-term break point 134.28. This is also yesterday's intraday, yesterday's low actually. Break above this is to delay immediate bears for some stronger recovery, but in any case, break above yesterday's high at 135.18 and another I do apologize, another Fibonacci barrier at 132.47 that marks are we in the correct chart? I think no. I do apologize for this. The Fibonacci barrier at 132 130 pardon, break above 135 and 135 135.13 to open 135.31. that marks 50% of the entire down move from 137.10 to 133.52, and basically this is required to improve the near-term structure and possibly shift focus higher. Otherwise, we are still showing increased downside pressure, and the likely scenario would be seen on is expected to be the test of 133.52 and the further slide lower. A lot now depends on the release of Eurozone GDP that, according to the forecast, will follow French and the German one. With the sterling, strong bearish stances keeps driving the pair lower, as we witness early hours of European session triggered the brief break below 155.00. This is psychological support, and this was our next target after 155.30. I mentioned in the morning's update that some hesitation cannot be ruled out around this level, as oversold conditions on 1 and 4 hour chart might trigger some hesitation, possible corrective action. So far, strong pressure doesn't leave any space for any move higher, and sees potential for further extension. 155 being cracked. Next levels we can expect on the downside at 154.89 and 154.57. These are the lows of August 2012. We have them somewhere here. Pardon. 154. Wow. 154.89, 154.57, and then another strong one is 153.92, low of July 2000, 12th of July 2012, and basically these levels are expected to come in the near-term focus as the pair cracks 155.00. Also, what I mentioned previously, stronger bearish signal was given on the break, pardon, below 158.26. That was a 4-month range floor, and more significant is on the larger picture, main bull trend line, multi-year bull trend line drawn of 2009 low that was taken out this one of last week. That is seen as a strong bullish bearish signal, pardon, for fresh extension. Then we have a series of strong supports at 152.67 and 152.33, and basically these levels are expected to come in the near-term focus in case of clear break below 155.00 and the close below this level. Near-term focus will shift down towards this level. These are the lows of 2012 June and January 2012, along with the 152.71. We have October 2011 low, and these are the levels that are coming in the near-term focus after a clear break below 155.00. On the upside, any correction higher faces previous barrier at previous low at 155.71. This is also close to yesterday's intraday high. While any improvement, any significant improvement requires break above yesterday's high at 156.88 and the regain of 157 as psychological barrier in order to confirm some stronger recovery. Otherwise, stronger bearish pressure still sees as the main driver of the currency towards the downside levels. 154, we said 89, 154, 57, and then 153.92 seen as an immediate downside targets in case of clear break of 152.00. But of course, as I mentioned, there's some hesitation and some consolidative corrective action cannot be ruled out at this point as the near-term indicators are entering oversold territory. Dollar yen is in this sideways mode. If we take the near-term, very near-term structure of yesterday's higher low at 92.81, the price action entrenched between 93 and 93.76 approximately. These are the peaks with the neutral tone seen on the hourly chart. On the 4-hour, again, we are in the sideways mode despite 11th of February rally higher that posted fresh high at 94.45 and yesterday 12th of February at 94.40. We're still within this range 92.00 and 94.45. Again, the price is hovering around the 4-hour 20 days exponential moving average that is now moving sideways with slight positive tone still seen, while the price holding above 93.00 that guards 92.81 and the more significant 92 support zone. Loss of 93.00 and 92.81 would risk test of the lower boundary of the recent range at 92 area. That also marks 38.2% Fibonacci retracement of the upleg from 88.05 to 94.45 and would shift risk lower. Conversely, holding above 93.00 and the break above 93.76 and the 94.00 is expected to shift focus towards the recent double top at 94.40 and 94.45, break of which is required to resume the larger rally and the focus the 2010 peak at 94.97. Now we have Doji posted a lift yesterday on yesterday's close that signal. This is what I said, sideways movements. Still a hesitation. Basically, the near-term price action is currently directionless, and a break of either side of the near-term range between 92 and 94.45 is expected to give the fresh direction. Again, a lot of stories heard about Japanese yen and the recent and the coming G20 meeting, where one of the top focuses will be current currency war and the action of the Bank of Japan that some members still see as something that is unfair and incorrect, would give us some more hints and more clear picture of the fresh direction of the dollar yen. Just to mention that daily studies are very extended in the overbought territory and slightly skewed towards the downside. That overall could give some hints of possible stronger corrective action, with the initial trigger seen on the break below 92.00. And finally, dollar Swiss still within the range established a couple of days ago, 91.50 and then 92.18. This was the highest seen this morning, with the morning's action again seen attacking the upper boundary of the range. So far unsuccessful, but potentially still seen for a possible break higher, as hourly studies are showing now some improvement, slight improvement, but it seems that the range top is still capping, and we are still in the sideways mode. 20 days exponential moving average below the price at 91.72 now underpins, while 55 days one holds the range floor. Downside risk will be seen on the loss of 91.50. That will open 91.00 and possibly signal lower top for extension down towards 90.54 and the 90.20 our key support. Conversely, break above 92.18. This is the highest seen today. Opens Fibonacci barrier important 92.47. That is 61.8% of the down move from 93.87 to 90.20, required to signal some stronger recovery, while break above 93.00 is required to confirm. Daily bears are still firmly in play, as indicators all stay in the negative territory, and the evident is a reversal of the stochastic, as the price action remains so far capped by descending 55 days daily 55 days moving average, while downside is for now protected by broken main bear trend line drawn of 99.70 peak at currently standing at 91.30. We are in the sideways movements, but larger picture is tone is still skewed towards the downside, and improvement requires regain of these two levels, 93.87 and 93.77, 93.81, pardon, in order to improve the near-term structure and the signal base. Ichimoku studies, again, an interesting point. Daily cloud is keeping the upside limited for now. Penetration through this, which is currently at 92.09. We don't have the clear break. A few spikes higher, and that's all. With the Kijun Sen line again moving flat in the sideways, but capping the upside, but reversal of the Tenkan Sen starting to point higher could be initial signal. Of course, we need to see a lot of work. The price needs to break above the Kijun Sen line, and the Tenkan Sen has to go above this. Of course, above emerging above the cloud top, which is at approximately 93.00, is required to confirm. So we're coming back to the story of where we set break above 93.00. That is quite strong barrier. This is also Fibonacci 76.4% retracement to trigger some stronger recovery. And finally, the commodities. Meantime, you can prepare your questions to be submitted as soon as we finish, not to waste time. Gold remains under heavy pressure. Currently, we are facing some consolidative action, but the tone is still aligned towards the downside after the yellow metal hit a fresh low 2 days ago at 16.39 as a part of the larger down move following upside rejection at 16.84. This is the latest tops being congested there, and then fresh weakness through some important supports. First, it was 1660 zone that marked this range floor, and then previous low at 1651 triggered fresh extension down to 1639. Now back to the hourlies. Negative tone is still present in the hourly studies. Some slight momentum is seen built up, but still this is not enough for any stronger correction, as 1651, this is the previous low here seen here is still, as you can see, it's still limiting the upside. Two spikes higher were unsuccessful, and basically as the price returned nearly to the previous low, more focus is still seen towards the downside. For our 10 days exponential moving average is now offering initial limits, and all three are in descending mode, keeping the upside so far well protected. Of course, the absence of Chinese market that is shut due to the Lunar New Year is another thing. Some positive tone that we can see now, but some recovery was seen yesterday on the Asian jewelers buying gold, but from technical point of view, we are still quite, the outlook is still quite weak, and the immediate risk is seen on the test of recent lows at 1635 and 1625. These are the lows of 21st of December 2012 and the 4th of January 2013, 1625. That marks the annual low for the gold. Any improvement requires a break above initial 1651, and more significant is 1660 zone. This is the previous consolidation range floor, and also 200 days moving average, and sustained break here would prevent fresh weakness and possibly open way for some stronger recovery. But as long as we are holding below 1684 and 1700, not much to be expected. As the yellow metal, we can see, is now within the range, trading between 1700 on the upside and 1625 on the downside, and any improvement on the larger picture requires a break above 1700. This coincides with the main bear trend line drawn of 1795 peak of 2012, and break above these levels is to provide relief. Otherwise, a loss of 1635, 1625, that also marks 61.8% Fibonacci retracement of the larger rally from May 2012. This is critical support at 1526 up to 1795, a break of which is to shift focus down towards 1600 and 1590. That marks 76.4% retracement of the rally from 1526 to 1795. And finally, crude oil. On the hourly, let's move it in the proper one. Hourly structure is slightly weak at this point after price rally to 98.09, threatening previous highs at 98.12 and 98.22, while 4-hour structure is more positive and still sees focus towards the upside, as the subsequent pullback seen yesterday and spike lower down to approximately 96.60. That marks 50% was contained by Fibonacci and 55 days exponential moving average supports, seeing again more potential towards the upside as the oil price broke above the recent congestion at 97.00 and spiked at 98.09, just ahead of our key barriers 98.20, 98.12 and 98.22, break of which is to signal resumption of the uptrend, the larger uptrend from 84.05, low of 7th of February, 7th of November 2012, and of course another strong barrier seen in this zone is 98.54. That marks 61.8% Fibonacci expansion of the upleg from 84.05. As said, immediate support yesterday's spike low at 96.60, reinforced by 50% retracement, is seen as a strong support. Before this, we have days sessions low at 96.93. Basically, the previous peaks and the congestion tops are acting as a good support now, despite being cracked on yesterday's spike down to 96.62, and this is our break point in the near term. If we see the break below 96.62, then all these gains would be seen as a false break, as the price would again shift focus towards the downside levels. For now, we are seen well supported with 20 days exponential moving average holding the downside at 97 zone. This is the previous resistance, now acting as support and reinforced by 20 days moving average, with the bullish crossover at 96.42 underpinning the advance. Of course, we need to see the extension to 98 zone, above 98, in order to confirm the bulls, but break above 98.22 and I would say 98.54 and close above these levels is to shift focus again towards our near-term target at $100 per barrel. That is seen quite likely in the near term after break above this congestion that lasts since end of January 2013, with downside being well protected so far at 95.00 zone. And that's all from me. Please, if you have your questions, you can send them now. I'll be glad to answer. Silver. By the way, you can find the technical analysis for commodities on the daily basis. If you are a client of Windsor, then you receive it through your platform. Otherwise, you can find it on a number of financial sites. Among them, I think it's FX Street, one of the most popular, where you can find the gold, silver, and the crude oil on the daily basis, short-term technical analysis prepared by me. Okay, silver. Let's just put the screen. Now the pressure is evident towards the downside after the price action broke. There was a consolidation, triangular consolidation seen in the past couple of days, and the break below these levels. This level, loss of 31.30 as a range floor, and the 31.00, as well as previous low at 30.72 has seen stretch to 30.57. That is lowest seen so far, and this is basically where the 200 days moving average so far held the downside protected. But overall picture is still, we can see that dailies are losing traction at this point, and we might expect some further weakness following 2 days ago recovery up to 31.20, basically just under the previous range floor, now acting as resistance, and also 38.2% retracement of the down leg from 32.25 to 30.57, keeping the downside protected. So far, this is also reinforced by descending 55 days exponential moving average, and fresh slide seen yesterday to 30.71 with close below 31 psychological support. Sees again more risk towards the downside, as 4-hour indicators are holding in the negative territory. Any recovery higher should be ideally contained below 31 or 31.20. Otherwise, any break above this might be a signal for some stronger corrective action, but a lot of work seen ahead in order to improve the near-term structure that is still in the down move. We can define this channel. If we draw the linear regression channel, then we will see that the price is still more pressured, as the linear regression basically held the upside protected, and we are channeling lower at this point. With the daily structure, the range already has already been cracked. The range floor at 30.72. Now the support, good support at 30.62, which is 200 days moving average, loss of which, and 30.45, 61.8% retracement of 29.21 to 32.46 is to open way for further weakness. Overall, the negative tone still dominates and still sees the downside favored, as break below 30.57 is to open 32.45, and then 30.00, that is equivalent to approximately 76.4% Fibonacci retracement. While on the upside, lift above 31.20, 30 is required to provide the near-term relief and allow for some stronger correction. But in any case, anything below, I would say 32 would be just seen as corrective action and further consolidation before a bearish resumption. Otherwise, break above what are the previous peaks, 32.25, 32.46, that could shift short-term focus towards the upside, as the pair is holding, the price is holding below the 50% midpoint of the rally from 29 to 21 to 32.46, still keeping the focus more towards the downside. Is there any other question? Yeah, it seems that was all. Pardon for today. I do apologize for my voice. I have had some problems due to the heavy flu that is in our island, and a lot of people are suffering from this. In any case, I would like to thank you all for being with us, and expect to see you tomorrow again. That will be the last session of the week, as tomorrow is Friday. We are back at the same time at 8 o'clock GMT. Until tomorrow, wish you a nice Thursday, and of course, good luck in your trading.